Good afternoon.
Good afternoon.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after.
Well, we waited for years. That was it. I added a little portfolio
Recent
tracker,
suggest
rigged
that
it up this
economic
morning.
activity has
We're up
continued to expand at a
2.9%
solid
today.
pace.
You know,
GDP rose
3.1.
at
The
an
market
annual
likes
rate
it.
of 2.2% in the first half of the year, and available data
I have an
point to a
interest
roughly
rate
similar
sensitive
pace of growth
portfolio.
this
Very,
quarter.
very sensitive.
Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year.
Jeez, we're
In the
selling
housing
like
sector,
a madman.
investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index
He's talking
and other
about the
data
rate of
indicate
inflation,
that
not the
total
actual
PCE
prices of
rose
things. Those haven't
2.2%
changed.
over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation
doing some
expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets.
Bro.
The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%.
Yeah, we're cruising.
Our monetary policy actions are guided by our dual mandate to
All my
promote maximum
indicators are
employment
flashing
and
green.
stable prices for the American people. For much of the past 3 years, inflation ran
My
well
system's
above our
selling
2%
Bitcoin,
goal, and labor market conditions were
buying
extremely
hedges.
tight. Our primary focus had been on bringing
trying to
down
sell
inflation,
puts I don't
and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food,
I mean, we're at
housing,
all-time
and
highs.
transportation. Our restrictive monetary policy has helped restore the
The
balance
highest
between
candle
aggregate supply
print
and
I
demand,
saw is
easing
568.6
inflationary pressures and
on
ensuring that
SPY.
inflation expectations remain well anchored.
And I am
Our patient
hedging
approach over the
'cause I
past
don't
year
trust
has paid
this
dividends.
even a little bit.
Inflation is now much
definitely
closer
gonna come
to our
back down.
objective, and we have gained greater confidence that inflation is moving sustainably toward 2%.
I mean, everything is just tanking.
As inflation has declined and the
going
labor
up,
market has cooled, the
inverse
upside
funds are
risks to
tanking.
inflation have diminished, and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance. And we are attentive to the risks to both sides of our dual mandate.
All right, there
in
we
light
go.
of the progress on
reversal.
inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.
I called it months ago because I'm in
This
touch with Mr.
recalibration of
Powell,
our
even though
policy
he's fucking
stance
ruined my
will
life
help
by
maintain
raising
the
rates
strength of
faster
the
than
economy
any time
and
in
the labor
history
market,
during a
and
war.
will continue to enable further progress on
Give me
inflation
a lot of tax
as
debt.
we begin the process of moving toward a more
tax
neutral
credit.
stance. We are not on any preset course.
Got a lot of tax
We'll continue to
credits.
make our decisions meeting by meeting. We know that reducing policy restraint
How fun
too
is this
quickly
little live
could
counter
hinder
I rigged
progress
out?
on inflation.
Look at this guy.
At the same time,
What
reducing
up?
restraint too
What up, what
slowly
up?
could unduly weaken
This is
economic
for one of my
activity and employment.
portfolios. It's especially sensitive to
Considering
interest
additional
rates, so
adjustments to the
figured it'd
target
be a
range
good
for the
one.
federal funds
Got a
rate,
bunch of
the
bonds
committee
in
will
there.
carefully
See how
assess
bonds are
incoming
doing.
data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants
doing
wrote
much.
down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4%
I can't help but buy
at the end
hedges.
of
I just don't believe
2025.
this.
These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks.
I do not believe
These
you.
projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists,
Get my
we can
autobiography.
dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual
Whoa,
mandate.
shit! I didn't mean to sell that.
The Fed has been assigned two
live
goals
mistakes.
for monetary policy:
Live.
maximum employment and stable prices. We remain committed to supporting maximum
We're
employment,
live here. I did
bringing
not mean to
inflation
sell
back
that.
down to our 2% goal, and keeping longer-term inflation expectations well anchored.
Let's
Our
see the
success in
damage.
delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and
Make
businesses
bad
across
bucks.
the country.
No damage.
Everything we do is in service to our public mission.
Still bad.
We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you, Mr. Powell. Sucks that you did it. Bad to
Steve
begin
Leachman,
with.
CNBC.
but
Thank you, Mr. Chair, for taking
whatever.
our questions. In July, you said you weren't necessarily
Mr.
thinking about a
Leachman.
50. You didn't want to be specific, but you said you weren't thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third-quarter GDP running 3%. So what changed and made the committee go 50, and how do you respond to the concerns that perhaps
This
it shows
market
the
is
Fed
going
is more concerned
down.
about the labor market?
First, it's going to spike
and
up.
I guess should we expect more 50s
Stop out
in
the
the months
shorts,
ahead?
then it's going
and based
down.
on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the
Why is
two
consumer
employment reports,
staples
July and
tanking?
August. We've also had two inflation reports, including one that came in during blackout.
I don't know what that's about.
We had the
Risk
two
on,
CEW
maybe?
report,
Risk
which
on?
suggests that would suggest that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. So we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's
Who do
one
you
question.
serve? Tell us who
What
you
was-
serve.
What was the second and third?
The American Republic.
Sorry, thank you, sir. How do we
Republicans.
figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things.
I mean, it's
A
risk
good
on
place to
for
start
sure.
is the
For
SEP.
sure.
But let me start with what I said, which was
All my
that we're
indicators
going to
are
be
flashing
making decisions
green,
meeting by meeting
and I'm going
based
red.
on the incoming data, the evolving outlook,
I do not
balance of
believe it.
risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time.
I think
of
we're
course,
in a trend update for
that's
sure.
a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. Again, I would point you to the SEP as just an assessment of where
QQQ made new all-time highs, 478.81.
The individual members, rather, of the committee are thinking today.
Already gave you SPY.
Assuming that their particular forecasts are realized.
I should have had a put.
Hi, Chris Rugaber at Associated Press. Thank you.
Sell to close.
The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid?
I'm taking all trades off the table.
Or does it suggest that maybe people see the short-run neutral as a little bit higher than thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know.
A lot of people say it's not, brother.
That the policy stance that we
say
adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%.
I told
Today,
you we're going down.
Unemployment is up to 4.2%, and
hey,
down to a few tenths above 2.
Got out of a bad trade.
We know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment, moving to a more sustainable level. So the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
So it's a loss. If it's not a win, it's a loss.
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005,
TLT,
I think.
Volatility is getting juiced up.
Weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back,
those coffers
I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted
My
on.
auto buyer was able
I would add
lock in.
Look at the SEP. All
pretty
19
good
of the participants
hedges.
wrote down multiple cuts this year. All 19.
Well, time will
That's
tell
a big
on that
change
one.
from June, right? 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year? For example?
We're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability.
But the price of eggs,
make a good, strong start. But
he's talking about the rate of the price change, not the change itself. The absolute change baked into the system.
But I think we're going to go carefully, meeting by meeting, and
baked in.
and make our decisions as we go.
Baked in.
Gina.
What do we have? VIX is 17.
New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition.
It's risk on. We're going right back up.
With our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing
more hedges
at a
I'll
solid
take all the
pace.
Hedges.
Inflation is coming down.
I'll take the other side
labor
of the
market is
trade
in a
all
strong
day
pace.
long.
We want to keep it there. That's what we're doing.
Fucking pay me. There's no way we're going to stay at these levels. They're definitely going to sell it.
Does today's action constitute a catch-up in action given recent substantial
Maybe they want to go
data?
to the next fib
Or
on
is this
SPY, which is
larger than
right at
typical rate
600.
cut, a function of
Doubt
the
it.
elevated nominal level of the policy rate, such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there. So I would say we don't think we're behind. We do not think we think this is timely, but I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to
tick by tick, right?
What might be expected if you're trying to maintain equilibrium?
So I think it's about we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, "Oh, this is the new pace." You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level. And we're moving at the pace
See if I can show you guys what I'm looking
appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With the larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been
Shout
stable.
out to Cheddar Flow.
So reserves are still abundant
Cheddar Flow.
and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby.
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply? Or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? clearly payroll job creation has moved down over the last few months, and this bears watching. Meant by many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that
some of this junk
we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
The point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies that that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions.
You have a full life ahead of you. There's no reason.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if, as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So. And policy, we think, is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment, and it is going to take a significant amount of monetary easing to just maintain it.
So this order I have in.
What I would say is
there's a good idea, bad idea.
Need to see
$50. I mean, it's all relative, right?
Conditions to get inflation down to 2%.
Throw a little bit into.
But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation.
Come and get it.
That's what we're trying to do.
Come and get it.
And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Up 0.73%. You can get it.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%.
Algorithmic buying.
That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing.
So we're in a range.
Wages are still a bit above what would be, their wage increases rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person, as measured. It's now below around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, I could go on and on. There are many, many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been
the do not pass line. Yeah, we don't want to pass this line. This is the do not pass line.
So what we say is, as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
Expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see
Elvis lives.
Another jobs report. I think we get a second jobs report on the day of the
bonds
meeting.
Are all the way back down
on the Friday before the meeting.
Start buying these guys.
And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks.
This number is so freaking cool. I can barely stand it.
To do.
That's a live number. I rigged that up today. I just rigged it up out of nothing.
Of our goals over time. So
that's literally exactly what I mean. I have many portfolios, but this one. That's exactly what I'm seeing.
Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think we are. It's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of
we lost a percent or two
tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Joe Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal.
Sorry, guys. The shit I do is awesome.
4%.
I think that's awesome.
There's basically an entire generation that has experienced zero or near zero federal funds rate. Now, some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this
100%.
After we get through all of this,
as long as they're going to keep printing, that's 100%. That's why I buy Bitcoin.
We can only speculate about it. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates.
We'll get there.
It looked like the neutral rate might even be negative. So people were issuing debt.
All right, let's see if QQQ holds.
It seems that's
looks like
so
we found
far
some
away
buyers
now.
Here.
My own
the
sense
real
is
buyers
that we're
will
not
have
going
to show
back
up
to
around here.
But honestly, we're going to find out. But it feels to me, and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. We only know it by its works.
One more. How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah, so this is my fourth presidential election at the Fed, and
this
it's
is
always
weak.
the same.
That's weak shit.
We're always going into this meeting in particular and
weak. Oh no! Look at the gains.
The right thing to do for the people we serve.
Oh no!
And we do that, and we make a decision as a group, and then we announce it. That's always what it is. It's never about anything else. Nothing else is discussed.
Double.
And
that's a typo.
I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind.
I'm negative. We went negative.
It's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Damn. It's a lot of volatility.
Thank you, Chair Powell. I'm Jolene Kent with CBS News.
Hi, Jolene.
My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
Buy Gucci.
I would just say that, the U.S. economy is in a good place, and our decision today.
I told you guys it was coming back down, but
the economy's growing
not yet. It needs to go a lot higher before it comes down. This is just a test.
Closer to our 2% objective over time.
Let's see.
And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level.
That is so freaking cool.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No.
Oh, you want to know where I'm getting hurt is on bonds.
Inflation,
bonds are hurting me.
What we say is we want inflation. The goal is to have inflation move down to 2% on a sustainable basis.
I choose patience.
We're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels. But they're not rolling over. The leases that are rolling over
drag you behind my fucking truck.
Coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this. But, the direction of travel is clear, and as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just one or two cycles of annual lease renewals.
All right, so took off basically all my trades
because I don't think the outcome is in doubt again, as long
as
we
pass the don't pass line
remain under control. The outcome is not in doubt. So I would say
maybe I'll do a trade.
The rest of the portfolio or of the
I think we have to go higher before we have the real don't pass line test. I bet we go higher.
They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get.
Like right around here, we're going to spring back right around here.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite
They're not going
demand
to pass this
in
line,
housing
otherwise
and see
we're
prices
FUD.
go up even more. What's the likelihood of that, and how would you react to that?
The housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not, obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And, I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Completely flat on the day.
Hi, Victoria Guida with Politico. Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags, and I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question,
I'd be up otherwise.
do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that
I guess
sort
some
of gets
of
you
it
to the same
was
place?
priced in as they said it was.
You're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, business people who are actually out there doing business.
Business?
I think, I think our move is timely.
Business time.
I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not that doesn't really answer the question that we ask ourselves, which is let's look, at this meeting, we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? It's clear that we clearly, literally, everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
What's that?
Thank you, Chair Powell. Elizabeth Schulze with ABC News.
Hi.
Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time.
I think they're going to sell it the second he's done
as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However,
this isn't selling.
The rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
I don't know. That's a pretty solid price
households
rejection.
Who are frustrated that home prices have still stayed so high as rates have been high. What do you say to those households?
Well, what I can say to the public is that we had we had a burst of inflation. Many other countries around the world had a similar burst of inflation. And when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is
you
that
guys,
people
I'm not going anywhere. Keep talking. I'm
not
listening.
thinking about
I got you
inflation
right
anymore.
here.
That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really it restores, it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on, and I think we've made real progress. We don't tell people how to think about the economy, of course, and of course people are experiencing high prices as opposed to high inflation, and we understand that's painful.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, could you talk, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? After the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
This tobacco leaf, purely only tobacco.
Thank you, Chair Powell.
Smoked in honor of Mr. Powell raising rates to begin with years ago, faster than any time in history
because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding
wait, did they cut 50 basis points?
But we will mentally tend to adjust them based on the
There's no way
adjustment, which you referred to. There isn't a bright line. It will be. The unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting. We'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Seems like I'd have 500 notifications on that.
Thanks, Chair Powell. Matt Egan from CNN.
Holy shit! They did a 50 BP cut.
How the Fed does.
Whoa, that's an upset. Oh, you did that just to spite me.
But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities.
That's a big cut.
Avoids.
Well, I guess you started with like 75.
Making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea. Is that and I think the data are clear that countries that have independent central banks they get lower inflation. And so we're not.
Well, what do we think about
we
that?
We do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
Let me we'll give you the second question. So, the answer to your question is that yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support.
Is there a date for that?
That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
On Unity.
And then yesterday there were merger reform finalizations from the other bank regulators. What does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr.
Where am I at? Flat on the
it's
day.
A good question, but I don't have.
If I sold a Unity call in the morning, let's see where I'd be.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think
neither of them matter. It's a virtual reality video game. We're all just LARPing.
The risks were on inflation. We had
super
historically tight labor market. Historically tight. There was a severe labor shortage, so very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Is the economy more vulnerable to a shock now that could tip it into recession?
I don't think so. I don't. As I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No, thank you.
Is that it? All right. Well, he cut by 50 basis points. Pretty crazy. What a journey it's been. Years, everyone thinking it's going to happen, then it doesn't happen, then it does happen, and it's no big deal. Cool. Thanks for the words. See